We are here with Tim Oddo with Luminate Banking, and he is going to cover a reverse mortgage for us. So we're going to 3 topics we're going to go over this morning, and it's going to be why would you consider a reverse mortgage, how would you use the money that you get from the reverse mortgage, and then also what are the qualifications to get a reverse mortgage. So welcome, Tim. Glad you're with us this morning.
Kim, it's a pleasure to be here. Thank you. Thank you for having me.
We're
Thanks,
happy
Amber.
to have you.
Yeah.
Yes.
All I've heard is great things about your knowledge about this, so we thought we would help share it.
Have an expert.
Have
Well,
an expert.
Yes.
Listen, it's great. I mean, this loan suffers from a lot of misconceptions and misunderstandings.
Mm-hmm.
And so therefore, it's important to get the education out there because most of those things are completely false. So hopefully we'll do some to dispel some myths here this morning.
So why do you think that reverse mortgage got such a bad rap?
Yeah, I mean, reverse mortgages have kind of a storied past. The very first reverse mortgages were done way back in the early 60s.
Oh, wow.
So they've been around for over, 50, 60 years. The problem is initially all those early reverse mortgages were done with private lending institutions or private companies. And so when
Like banks or
like maybe a bank, but it wasn't like a government insured, or it wasn't
Like a hard money lender almost?
more like that. So what happened in the early days is that when mom and dad passed away with the reverse, typically the bank would get the home.
Oh, I get that.
I remember that.
Yeah, and so to this day, that myth still persists. So you have these early 60s, so fast forward to 1988. In 1988, President Reagan, okay, going back a few years here, right? Huh? Remember
Were
that?
you born 88?
Yes, I was 4.
Just barely. Yeah. Unfortunately, I was a little older than 4. But in 1988, President Reagan signs into law the HECM bill, HECM, HECM, and HECM stands for Home Equity Conversion Mortgage. So the HECM bill was signed into law. Basically, the government now was in the reverse mortgage business. Now, overall, that's been a really good thing because the government is not out to purposely take mom and dad's home. They don't want to foreclose on mom and dad. And it's just a FHA loan. So when mom and dad, they can live there as long as they want, as long as they can. When they pass away with today's reverse mortgage, the home goes to the estate. It goes to the heirs. It doesn't go to the bank.
So
okay?
that's the bad
The
rap.
big rap.
I think
It's like
a lot of
testosterone in that one hormone study back in the day.
Yeah, it's not all bad, right?
No.
Yeah, it's good to have a little. But for whatever reason, I mean, these myths have persisted, but simply stated, it's just a loan secured to the home. It's actually a government insured loan, and it's there to help seniors age in place, have a more comfortable retirement, and have more access to financial peace of mind, right? If you
So
will.
I heard you say it's an FHA loan. So you can't do a conventional loan with a reverse mortgage?
Well, most reverse mortgages, the HECM reverse mortgage is an FHA loan. Kim, it's FHA insured. That's the bulk of the reverse mortgages that we see that take place and that are originated in America today.
Okay.
There is one other classification of reverse mortgage. It's what I would call a jumbo reverse mortgage.
No.
So typically it's a non-FHA loan, but it's usually for properties that are 1.2 million and higher.
Okay.
So a jumbo,
Didn't even know that existed.
Yeah, so you could have somebody who had a $3 million property and they own it and they want to borrow some money out of it, but they want to take advantage of some of the reverse mortgage characteristics, which we'll talk about today. But the bulk of the reverse mortgages done in America today are the FHA or HECM reverse mortgage.
Okay.
Yeah.
Learn
All right.
something new every day.
Yeah.
So what are the qualifications to get a reverse mortgage? Or maybe let's start with why would you get a reverse mortgage?
Yeah, okay, so 2 things. Number one, I mean, a reverse mortgage is, again, the most misunderstood product out there, right? And folks are like, well, I don't really need it. There's these misconceptions of this is a loan of last resort. It's not a loan of last resort. This loan is meant to keep mom or dad in the home for as long as possible and to give them more financial freedom, right? So to me, some of the qualifications, I'm going to tie in the question.
Perfect.
I'm going to give you the answer, tie in both questions. One of the qualifications, you have at least one of the people on the loan has to be 62 years of age or older for a HECM reverse mortgage.
Okay.
So, Amber, you don't qualify.
Dang it.
Okay. Well, you don't look like you qualify either, Kim. All right. I'm almost qualifying, but not quite. Close. But so you have to be, typically retired or semi-retired, right? So that's part of the thing. So when you do this loan, the idea is if you want to stay in the home a long time. To me, if you're 70 years old and now you've permanently retired and now you're getting Social Security and your plan is to live there a long time, right? As long as I can, and I have a bunch of equity in my home, that is, reverse mortgage is a great tool, a great product to let you age in place longer, to give you more financial cash flow, to potentially pay you money in the form of an additional income and that kind of thing. So it's varied, right? There's a 1,000 different scenarios.
Yeah.
I have 1,000 different questions for that, but go ahead.
Yeah. So no, go ahead. Yeah.
Well, so we own our home free and clear.
Right.
Right. So why would we? When you're saying I would get money with that, I would get paid money. How is that?
Okay. Let's talk about that. So I just closed a loan a couple weeks ago for a woman that lives over by City Park, and she had a $700,000 home. She owned it free and clear. And you don't have to own your home free and clear, by the way, to qualify for reverse.
Good to know.
But you have to probably have 50 to 60% equity in your home. So that's an important factor, right? Like if you don't have at least 50% or more equity in your home, you probably don't have it. Probably don't qualify. Okay. But so for instance, for this woman who has a $700,000 house, we refinance it. We do a reverse mortgage for her. We're going to pay her $1,700 a month. Every month for the rest of her life, guaranteed, no matter how long she lives.
Well, how's that based?
It's an actuarial. Really, a reverse mortgage is an actuarial loan. So she's old.
They're
She's
guessing
older.
how long she's going to live.
Yeah, they are
Okay.
correct. This woman's was about 78 years old. So they're kind of factoring in. Okay, how long is she going to live there? How long can we pay out? This money. So we're paying her $1,700 a month every month for the rest of her life. In addition to the monthly payment. Which, by the way, is tax-free. There's no taxes on money you receive from a reverse mortgage.
Wow.
Okay. So you said she had a $700,000 home. How much money did she get from that $700,000?
She qualified for about roughly 50%. So she qualified for roughly a 50% of the value. She could borrow up to about 50% of the value of the home.
And what was that qualification to get that?
It was just based on her age and what the current rates are right now.
Okay.
Though that basically determines how much you can borrow.
Would it be age, current rate, and the guess of the price of the home? I'm guessing the appraisal, correct?
Correct. So on all these loans, again, they're FHA loans, right? So you guys have familiarity with this.
Yes, we do.
We got to do an FHA appraisal on every loan. Every loan is fully, full FHA appraisal and all that.
Okay.
It's not, it's not magic. We're not doing anything. It's not smoke and mirrors behind the scene. I mean, it's just a normal loan process, right?
So she has a loan, and the loan is paying her. That's why it's called a reverse.
Correct. The
Instead
loan's
of her
paying
paying
her.
the loan's paying her $1,700 a month.
Correct.
She gets that in addition to her Social Security.
Correct.
So
tax-free.
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 And on top of that, Kim, she has an additional, because we could have actually paid her a higher amount every month, but we cut it down to $1,700 a month so that she could have another $50,000 or $60,000 line of credit on the side that she could borrow from in the need of needing something, a bigger ticket item, right, or a long-term care event or something where she needed a bigger chunk of money. So not only is she getting $1,700 a month, she also has a $50,000 or $60,000 line of credit that she can draw from if and when she needed it.
And you did that at the same time?
Yeah, it's all done simultaneously in the loan. And now, Amber, she may never borrow any money out of that line of credit.
It's there.
But it's there to
Is it
borrow
like-
if she needs it.
Is it like a home equity line of credit?
It is like a home equity line of credit or HELOC.
Wow.
Think of this as a reverse HELOC. So one of the great things about someone who owns a home free and clear, Kim, right, is that even if you don't need the monthly income, now, for her, it was great because this allowed her to live in her home. She goes, this loan is going to make it possible for me to continue to live in the home,
Wow.
right, which is great, not move out because she's still healthy enough, but she needed just a little extra money every month, plus have the safety net of the line of credit. But in the case of if I'm 65 and I own my home free and clear, right, and I go, you know what, I don't need the money right now, I'm still working, I could take out a HECM reverse mortgage, put all the money in the line of credit, so instead of me borrowing, paying myself, I could have $300,000 in a line of credit.
That's so cool.
And that line of credit's just there if I need it. Here's one of the best kept
So
secrets.
I'm not paying anything, like, at the end, keep going.
I
I'll
wanna
ask
hear
you
the
about the
secret.
end. Yeah, go ahead.
Okay. Yeah, no worry. Yeah, let's get back to that. One of the best kept secrets about this is this is a great avenue for long-term care needs, long-term care policies. I've come across so many people. I've got a woman literally right now I'm doing a loan for. I just met with her yesterday. Her and her husband paid into a long-term care policy faithfully for over 20 years. Her husband got dementia, got really sick. They got zero money out of that long-term care policy, zero. And they went through all the hoops over and over, nothing. So for her, they changed.
They changed is what happened. So our accountant told, because Dave and I were at that age where we had to consider to start
We're at that
the
age.
long-term care. I'm at that age. Thank you.
Sorry, I mean, you put
I
mine
did
in there.
birth you.
You don't look like you're at that age,
I
Karen.
Yeah.
know,
Huh?
she really does.
She doesn't.
But
She
we're
doesn't.
at that age thinking that we needed to do that long-term care, and our accountant, God bless him, he said, "Don't do them.
Yeah,
Don't do them
yeah.
because invest your money, better in another way than paying that out because that's what happens. The insurance that what you bought, that product is no good.
Right. That's
Oh,
right.
that's so
It may not be
sad.
good. They may not honor and pay anything. The other thing is that people get priced out. So you live longer than you should. Pretty soon you can't. That premiums go up. You can't afford the
Premiums.
and then you stop making the premium on that, Amber.
Then you lost everything.
You lost everything. So you paid into it. You'd be way better off, especially in a free and clear home. Take out the reverse mortgage line of credit. Let that go. Use that in the event of a long-term care event or any other really big life event. But additionally, here's the part I wanted to get to. That money in that line of credit actually grows at whatever the effective rate is of the loan. So the effective rate of a reverse mortgage today is about 6% right now.
Is it really?
It is.
That's low.
So they're getting 6%
Interest on money that they have.
that they already have.
They're getting 6% growth. We call it a growth factor. But yeah, so if I had a $300,000 reverse mortgage line of credit today, I'd be getting about 6% growth on that annually. Now that ebbs and flows with what the rates are doing,
Sure.
right?
Right.
Obviously,
Everything
if it
goes.
was up a little higher, you get higher growth. If it goes down to 4, which we kind of hope it'll get a little bit better, right?
It's going to.
It's gonna go, but still, you're getting 4, 5, 6% growth on this line
Money
of
that's
credit.
just sitting there.
That's just sitting there. So really, if I do it at 65, by the time I'm 80, depending on what the rates have been,
Wow.
it's probably I could have $500,000 or $600,000 of real money that I could borrow back for long-term care needs.
From the money that you borrowed from yourself.
I'm just, really, Amber,
That's kind of cool.
it's really cool. Really, all we're doing is we're going, hey, look, we're going to let you have access to some of your equity, not all of it, some of your equity to borrow back from yourself. Now, here's the best news. Any money that I borrow back, let's say I'm 75 now, and I've got $400,000 in my line of credit, and my sweet little granddaughter that I love with all my heart's getting married, and they don't have the funds for it. I can go in there and go, I'm going to take $50,000 from my HECM HELOC, right? My reverse HELOC. I'm going to borrow $50,000 to pay for my granddaughter's wedding. I borrow $50,000.
I don't know that I'd be that generous. Just so you know.
I'm aware.
Just letting you know.
She only has one
Sure.
granddaughter in town, so
Yeah.
we're hearing you.
Yeah, loud and clear.
I have 2 in town.
Oh, that's true.
But you got a really sweet daughter.
Yeah, I do.
Okay,
Yes, I do.
Okay. All right. But you could borrow that money, right? Or for anything, right? I mean, I'm just using
know.
that as an example.
I'm just kidding.
But any monies you borrow from that, a HECM reverse mortgage does not require you make a monthly mortgage payment. Okay? So this is what's misunderstood. Everybody thinks, oh, that's too good to be true. It's not, again, it's not magic. What happens is this: if I borrow $50,000 from my HECM line of credit, every month that I live there and I'm not making a monthly payment on it, then an interest-only payment accrues to that balance. So my $50,000, just the interest, yeah, not a principal in here, right? Because I'm not making a payment. So an interest-only payment grows on that $50,000. So 5 years down the road, if I, maybe I owe $80,000 on that, right? Because I haven't made a payment. But I've been able to live there rent-free, been able to borrow some money, some equity out of my home, and it makes it easier for me to live on Social Security alone, right? Or just gives me more financial flexibility.
And the interest on that fluctuates as well with the market, correct?
The interest on that, yes, correct. So whatever the interest rate that you've borrowed, any money you've borrowed, Amber, that's growing at that fluctuating in, it's a variable rate. The money in your line of credit grows at the exact same rate. They mirror each other.
Whew, my mind is rolling with possibilities now. So if this is my other idea, which I'm sure you've done a lot. So these people, they've got their monthly mortgage payment coming to them, which is hilarious. Their monthly mortgage, did you hear that, is coming to them.
Just one thing to remember with that is that you still have to pay your taxes, and you still have to have your homeowner's insurance. You can't get away from that, because if you
That's
don't pay those things,
That's right, Kim.
It's
That's
not
right.
good.
Well, you
That's
should
right.
always do that.
Right. Well, I mean, right.
Well-
We all know. I mean, even if you own your home free and clear,
yeah, you
still-
have to do
You
that.
should
Right.
still have insurance and pay your taxes.
100%. Because if you don't pay your taxes, they're going to foreclose on you. They're going to take
Yeah,
your
they're
home.
gonna take it.
Right.
They get the number one lien spot. Okay,
Yeah,
but,
exactly.
So you have the payment coming to you,
Right.
and then let's pretend I have 100 in my HELOC, or my HECM HELOC.
Right. There you
Okay, so I can use that money to go buy another property because I'm older and I'm retired and I want to go to Florida. Can I go buy a second property with that money?
go. Absolutely.
Cool.
Yeah. So this is really cool. So you have the HECM HELOC in place. You've lived there for 10 years and now you're fully retired. Now you're like, yeah, I'm tired of winters in Colorado. By the way, I'm in that group too. I wouldn't mind escaping to Florida for about 4 or 5 months a year. I mean, the rest of the time it's great here. So I could take $300,000 from my HECM HELOC that's grown and that's there, pull it out, go pay cash for a home in Port St. Lucie, Florida, pay cash for it. I have no
I think
monthly
he has
payment.
the home.
I know. Are you ready?
Yeah.
He's been looking.
Yeah, maybe. Yeah, my wife's from Florida, so yeah, I might have a
Okay.
little strong leaning there. But go pay cash for that home. I have no payment on that except for the taxes and insurance.
Mhm.
And then I have technically no monthly mortgage payment on my primary residence, the home that I live in most of the time here in Denver. And I'm living there, and now I have a second home. By the way, that home's appreciating too, right? Hopefully.
Yes.
Right? Under normal
Yeah.
circumstances. So not only when I pass away do my kids get
2 houses.
they get 2 houses that hopefully are both appreciated. And again, just circling back to your initial question, a reverse mortgage is misunderstood because people think that when I pass away that the home goes to the bank. It's like, that's not true.
Okay, so hold on a second.
Yes.
So let's say that I'm married,
Right?
and we had these 2 homes in joint tenancy.
Right?
Let's say that one of us passes.
Right.
What happens?
Okay, great question. So you're both on the loan, you're both in joint tenancy.
Mhm.
So you qualified for the loan together.
Mhm.
Your spouse passes away.
Mhm.
You can continue to live there, no interruption, nothing. You're going to alert the lender that your husband's passed away,
Mhm.
and you're going to continue to live there for as long as you want.
So you don't have to redo anything.
You don't have to redo one thing.
That was a great question.
That is a great question, and let me tell you, this is something that I push a lot. It's kind of a morbid thought, but the truth is we're all, I'm married
It
too.
happens.
And listen, I'm at a disadvantage to you ladies. Let's be honest.
Yep.
There's a good chance I'm gonna pass
gonna
away
die
before.
sooner.
I'm gonna die sooner than my wife. But a reverse mortgage is kind of a little secret hack because it makes it easier for the surviving spouse to continue to live in that home, right?
Because you're getting paid.
Because they're getting paid. Well, yeah, and even if they're not, depending on how they set it up, right, Amber, it's going to make it easier because you're going to have a pot of money you can draw from. It doesn't put, especially again, let's assume the guy passes away first. It doesn't put mom under as much pressure to have to, I can't afford to live here.
Yes.
Listen, take a year or two, right? This is going to give you a longer runway. It's going to give you more longevity of all of your assets and finances to be able to make a smart decision, right?
Hold on.
Yeah.
Before I lose mine.
Uh-huh.
Okay. So if I don't have 100%, my house isn't free and clear, right?
Yes.
And let's pretend I have 50%. At that point, that 50% that I'm getting paid for my reverse mortgage, could I just pay that to my
First mortgage.
first mortgage and then I wouldn't have a payment?
So
Or that first mortgage goes away?
that goes away. So
Okay.
so with it, so that's a good question. So let's go this way instead of doing on a free and clear home. So free and clear home gives you so many
A lot of
Options.
advantages.
a lot of options, right? You can pay myself. I can have a line of credit. I can have a combination of both, right? On a home that you owe something on. So I did a reverse mortgage for my mom. Okay, I believe in this, Kim. You know what I mean?
I
This
know
is
you
not.
Yeah, you
Oh,
wouldn't
I
do
know
it for
you
your
do.
mom.
And if you
didn't
were
do
old
it.
enough, you would do it yourself.
I would.
Yeah.
So I did it for my mom. She lives in a condo, and at the time, the condo was worth about $200,000, and at the time, she owed about $100,000. So she was already at about 50% loan to value. Okay. Now this was right before COVID. So at the time that we did it, she just was looking. I'm like, why are you paying $1,000 a month, Mom? So we did the reverse mortgage. Frankly, because of her loan to value and what I could lend
Yeah.
her, Amber, she didn't really qualify to have much money left over. She had
Right.
you know, I don't know, less than 10,000 on the line of credit, not much to speak of. So we weren't paying my mom anything at all. But what we did was we refinanced, we paid off the existing loan.
Okay.
In its place, we put a new HECM reverse mortgage. And now we're like, hey, Mom, congratulations, you can live there rent-free now. So now my mom's basically, she's making $1,000 a month more because she's not making that payment, right?
Mm-hmm.
And so then COVID hits, you know, a few months later, and she basically is like, well, I'm nervous and I'm worried. So she was able to quit her part-time job. She doesn't make a lot of money, but she was able to live there rent-free on her Social Security, and it, you know, it made it possible for her to, you know, it extended her time there.
So was she able to get money with that 50%?
No, so in her case, most of that 50% went to just paying off what she already owed,
Okay,
right?
I gotcha.
Because we had,
sure enough.
right? It has to take the place
But
of.
she doesn't have a payment.
But but I'm saving her $1,000 a month.
That's a lot of money.
That's a lot of money. I mean, that's real money. I mean, it's like it's like me sending her $1,000 more in her Social Security every month, right?
Yeah, oh, absolutely.
Effectively. So
Yeah, well, plus it's not taxed.
plus it's not,
And some Social Security's taxed.
yeah, that's a good point. Yeah, that's a good point,
That's a
right?
really good point.
Yeah.
Okay, so when, I'm sorry, I don't want to use your mom as this example.
No,
So
that's
when
fine.
somebody else passes away in that scenario, there's still 50% of the property left, correct?
I'm glad you asked that. So
Okay.
because that's so the first big misconception, Amber, is like when mom dies, the bank gets home. It's like, no, that's not true. When my mom dies, if it's God forbid tomorrow or 10 years from now, when she dies, the home goes to me. I'm her heir. I sell it for this.
We'll sell it for you.
Yeah. I'm gonna have Kim and Amber sell it for this. We're gonna pay off whatever mom owes, and then any equity and appreciation I get. So what happens is that, you know, it's been over 5 years now since we've done this. She had about a 50% equity buffer, right?
Oh, yeah.
So today, because I just looked at these numbers about 2 months ago, today she has a little bit more than 50% equity in that home still. So yes, her balance has grown, but the appreciation's outpaced it.
Yes.
It's stayed. So I there's no guarantees on this, right? We don't know what the market's gonna bring, but I would say on average, in general, you're going to maintain a pretty good equity buffer in there so that your heirs are going to walk away with something, because everybody thinks, I won't have anything when mom dies. It's like, that's not true.
Yeah, so the
Especially with
50,
yeah,
so
exactly.
the 50,000 that she has, that's paying her that $1,000 a month, is gaining interest.
Well, now that's not,
The HELOC.
yeah, she had a very small HELOC on hers,
Okay,
Kim. But most of the money in her reverse went to just pay off her existing loan.
okay.
So her big monthly savings is really the fact that we eliminated her monthly mortgage payment.
All right. So, but what I've heard is that, so let's say that you have it free and clear and you're getting this money.
Right.
When it's time to sell the house, what loan you had on it is gaining interest over all those years.
Yes.
So then your payoff is higher than what you borrowed or what your reverse mortgage is. It's going to be higher,
Right.
rather than lower, which is most mortgages,
Right. Correct.
right?
Yep.
Is that right?
That's right.
Okay. So let me make sure I
But
have that
because of
right.
the secret of appreciation, I don't know if it's a secret, but because of appreciation, it's not a secret. So, you know, even if she owes $150,000 today, her condo went from $200 today, it's worth about $275. So
Okay.
she still has about a 50%, right, buffer on, you know, roughly of what
Okay.
she did before.
Because that's what I've heard. You know, well at the end, when you go to sell the house,
Yes.
there's not anything left because of all the interest that accrued during the time you had it.
Yes, correct. And again, you know, this has changed over time too. This is part of the black eye that a reverse mortgage has. Is in, you know, 20 years ago, we would lend to a much higher loan to value.
Oh,
Okay.
okay.
So we gave to a much higher loan to value. There was no options to do a line of credit because maybe I don't need to borrow, take all the money out. In the old days, they would give mom and dad all the money at closing. So sometimes it would, you know, disappear.
What happens when you give a lot of people a lot of money?
Yeah, thank you. Right, that's a good
Yes.
way to say it. Right. So today, I mean, the truth is that, you know, rates are higher. Unfortunately, you know, the rates are higher, so that impacts, that lowers how much we can lend. And the fact is that HUD, the government, has lowered the percentages, the amount that we're going to lend anyway.
50 to 60 max, right?
So generally speaking, we're lending people, depending on your age, somewhere today, right now, about 40 to 50% of their equity.
Okay.
So truthfully,
that, yeah, you can't do it.
You
I
shouldn't
mean,
be upside down
you
unless
should-
the market went crazy.
I mean, Kim, short of the zombie apocalypse happening,
And that's
okay?
your favorite.
I like to use that one.
You
too.
do?
Yeah.
All right, that
They're
makes
always
me.
like, they're always like, well, what if? I'm like, yeah, and what if zombies happen
Yeah.
tomorrow? Like, if we're gonna play the what if game.
Right, that's what I told people. It was like, I mean, if the zombie apocalypse happens and the value of the home, but
Yeah.
this brings up a great point.
Uh-huh.
The zombie apocalypse happens.
There's no more value in homes
There's no more value
or
in
in
homes.
anything.
Or in anything, right? Yeah, exactly. We're all in real big trouble, number one. But number two, let's say my mom's home drops by 50%. Now her home's only worth $150,000 and she owes $150,000. Let's say she owes $200,000 in reverse. I'm going to give you an extreme example.
Yeah, do.
So now all of a sudden she went from here having 50% equity to being underwater. She can continue to live there because this is an FHA insured loan, right? It's a government insured loan.
They always get their money.
They always go, here's what happens. But in this case with the FHA, it also, there's protections for the borrower and their heirs. So
Okay.
my mom paid FHA insurance to obtain the HECM reverse mortgage. So if my mom dies and she is underwater on her loan, which she's not, I get the home still, okay? But then I'm going, oh man, my mom's underwater by $50,000. Then I go to the bank and I go, here's mom's keys. I don't want the home. I go like this, and I'm not on the hook for one nickel of any deficiency. So the FHA insurance pays back every last nickel of that deficiency, guaranteed to the bank, to the lender, for that loan. Now, again, we're talking about probably having a nice equity buffer.
Yeah, but that's huge because there's literally no way the heirs are responsible for anything. And your parents
100%.
got to live somewhere and had a home.
Right.
I mean,
And got to live there rent-free.
Rent
right?
free.
Yep. And live there. So there's really no downside risk to this loan, meaning that, if the zombies do show up, the best thing you could have done is have a reverse, because at least you could live there rent-free, maybe collect some money, right?
Wow.
The FHA insurance protects you. I don't think we see as much of that today because
The home values.
of the home values and the equity buffers that are built into this loan already.
No,
So it's more conservative in nature than it was 10 or 15 years ago or 20 years ago.
Yep.
But if they do show up, you're in good shape with a reverse mortgage. So.
Wow. I'm not seeing a downside. Is there anybody that this, besides age restriction, is there anybody that this doesn't make sense for?
Well, I would say, thank you for that question, because a lot of people go, well, you're telling me all the great things it'll do. A reverse mortgage is underutilized, misunderstood, undervalued, underappreciated. Way more, millions more baby boomers should have already done this loan than they have.
Oh, yeah.
But they don't understand it. They think you're going to lose your home and all the equity. So people go, well, why wouldn't I do this? The biggest reason not to do it, in my opinion, is if you think you're going to be in that home for probably 2 years or less.
And you're going to, okay.
Right? So if I'm sitting there and
you don't have value in the house, any more value in the house in 2 years, probably.
Yeah, you're appreciating something. And here's the thing with the reverse mortgage. The reverse mortgage does cost more upfront than a normal conventional loan because of that FHA insurance, right?
Well,
so the insurance that's going to
though.
protect us against the zombies
Yes.
is an expense that has to be factored in initially. So to me, it usually takes a year or two to pay back that initial upfront cost. So if you come to me and say, hey, my aunt wants to do a reverse, but she's moving to Florida in a year, I'd
Doesn't
say,
make sense.
I wouldn't do it. Let's do the reverse on your Florida home. Let's hold off, right? But if you come to me and go, I'm going to be here for at least 5 years or longer, or quote unquote, I want to die in this home, right? We get that with our clients.
That's why
It's cheaper for people to live in the houses.
that's why none of the boomers are moving right now, is because they can't find a house that they want that is like you. Kim and my dad went and looked at a property and they're like, this isn't anything more than what we have. It's only like less yard maintenance.
Yeah.
Why would we move?
Yeah.
And
I
have a very
think-
high HOA payment.
Yes, and
Right,
but I think that's
which
where
makes
a
it
lot
worse.
of
Yeah.
people are at, is like, why would I move?
Yeah.
Yeah.
Agreed. Yeah. And as we know, especially being in Denver Metro, it's like, right, you can't really downsize, right? You can't, you know, you're going to end up paying the same or more, especially with HOA.
Yeah,
and
chances
stuff.
with that, chances are the value of your home, you can go find. You're not going to save money by downsizing.
Correct.
It's
That's
going to
what
be
it
a
is.
lateral
It's
move,
a lead,
pretty
yeah.
much.
Thank you.
Yeah.
That's a good way of putting it,
Yeah.
right? In Denver.
Yep.
So this allows you to stay, and you're already more comfortable there, right?
Mhm.
You can find your way around in the dark with the lights turned off without stubbing your toe.
Yep.
You know what I mean? So
No.
people are more comfortable. Well, maybe.
Some mornings.
Yeah.
But I mean, you know, you're more comfortable there, right?
Uh-huh.
And so it makes more sense. So why not, you know, set up the HECM HELOC, the HECM line of credit, for the, you know, for a long-term care event,
Mhm.
for home improvements to make it easier for you to live there,
Mhm.
right?
For your granddaughter's wedding.
Of course.
Thank you for your granddaughter's wedding. How about this? I mean, you know, a lot of people do it just to say, hey, look, this makes me sleep better at night. To know I have 50, 100, 350,000 in my line of credit, and I can take one really nice vacation every year.
So they can't. Can they? So I remember during 2008, 9, and 10, people that had HELOCs, traditional HELOCs on their house, the bank cut them back or
Yes.
took them away.
Or took them away. Yes.
Could this happen with this?
No. Because of the FHA
insurance.
insurance, the FHA insurance
Get you again.
I mean, so this is, I'm glad you said that because that is the problem. I mean, today a HELOC is 8 to 9%, right? As we know,
Easy.
based on the rates,
Mhm.
you know, versus our rates, which are closer to 6%.
Mhm.
So the HELOC is more, you know, is more expensive typically.
Mhm.
Number two, a HELOC, just a traditional normal HELOC.
Mhm.
I have a HELOC on our, you know, we have a
Mhm.
HELOC on our house
Yeah.
just for reserve, right?
Just
in case, just in case.
Yes.
But the problem is, it's only usually a 5 to 10 year draw
Right.
period, and then you have to pay it back
Yep.
at an
Or
accelerated
renew it
pace,
or something
or renew
at a
it.
higher interest
They
rate.
can take it away from you, right, if they don't like the
Mhm.
market conditions.
Mhm.
In the reverse HELOC, the HECM HELOC, it's guaranteed for the life of the borrower.
Mm.
You can't take it away. It doesn't matter what conditions are. It's guaranteed to have that growth rate, right? No matter what happens, there's still going to be the growth rate because again, that's all kind of factored into that FHA insurance. So it's a lifetime HELOC. I love this. Again, if I'm 65
Mhm.
and I own my home free and clear, why wouldn't I just, instead of doing a HELOC
Makes
with the
no
bank
sense
down the
not
street,
to.
do a HECM HELOC, especially if I think I'm going to live there for quote unquote
10,
there
15
for
more
10
years.
yeah 10 or 15 more years of foreseeable future. Why wouldn't I do a HECM HELOC, put it in there, right? Let it grow. I've got it there as a backup if I need it. I know they can never take it away from me.
Mhm.
Speaking of that, another thing I know we talked about this before we got on camera was, you know, the qualifications. A HECM loan is easier to qualify for than a normal traditional conventional loan. And I'll tell you why, because when you're 65 or 70 and you've retired and you're on
Oh,
fixed
you're
income,
totally right.
like,
Having to qualify, having to prove income.
yes,
Yep.
and half the time or more, people are like, I can't get qualified. They say I don't make enough money. You know, when you hear that, I can't get qualified or I have a credit issue, think HECM, think reverse
That's such
mortgage.
A great point.
It's actually an easier qualify because you can borrow 200, 300,000 and you don't have to make a monthly mortgage payment. So it's easier for me to get them qualified
Mhm.
on fixed income, on Social Security, than it is for a normal loan.
Yeah, because Social Security, you know that you're going to supposedly get some kind of increase every year.
Yeah,
Be it little, you will get an increase every year.
yeah.
Cost of living.
Cost of living, right,
Yes.
right,
Mhm.
typically.
Mhm.
But you're going to qualify, but you're going to be able to qualify today, even if you never got another cost of living increase, Kim, you're going to be able to qualify to, based on your Social Security income, most of the time
Just a
with
loan.
just a loan. Yep.
So let's say that I have one, and 12 years later we have to go into long-term care. So I could sell the house at any time and not have any kind of
Penalty.
penalty. For,
Yeah. There's no prepayment penalty on a HECM loan, right?
Okay.
It's just an FHA loan secured in the home. So if you're there and your spouse passes away first, right?
Mhm.
Number one, it makes it easier for you to live there, right? Continue to live there,
Oh, that's what I was going to ask you before when you said that a spouse passes away.
right?
So now I'm not an accountant, so I don't know if this is really real.
Neither does he.
But and none of us are accountants here.
No, that's right.
But
You're
if,
definitely not.
so traditionally, if my husband would pass away, and there's a step up program with the IRS, the 500,000 equity in the home. You know, your first
Right.
500,000, you don't have to pay capital gain.
Correct.
How does this affect that, or is that gone?
Good question.
Yeah, that shouldn't have any effect on that. Okay.
Okay.
I mean that
So
step
if I
up thing
sell the
is
house, so let's say I sell the house and I have more than 500,000 equity in my home from when I purchased it.
right. Yeah, from the cost of the initial home, you
mhm.
still have to deal with the same. It still has the same
So it's the same, nothing
tax
changes
concept.
with that.
That shouldn't change that at all.
Okay.
I'm not a CPA, but I don't believe that should change anything at all.
Because what I have heard, I don't know for sure, that if someone passes away and you have 2 years to sell the house to still get that
For
500,000
the step up.
just 500,000
Versus
capital
two
gain
versus two.
Oh.
versus the
Okay.
250. After 2 years, if someone's passed away, you revert back to a sole owner and it's only the 250. So I
Okay.
didn't know how that affected that.
Yeah, I mean, I guess if nothing else, Kim, the HECM would allow you to make it easier transition in those 2 years, right?
Right.
Maybe you
Oh,
look
yeah,
ahead and go,
true.
hey, I'm gonna sell before the 2 years is up, so I get the full step up.
Uh-huh.
But at least it makes it easier for you to live there, right?
Or the full 500,000 cap gain relief.
Exactly.
Yeah.
Yep.
Yeah.
Now here's what we're gonna do, Kim. You're gonna sell that house a year and a half from now.
Uh-huh.
You had your HECM. You
Mhm.
pay that. You borrowed a little bit of money,
Mhm.
to help whatever, right?
Mhm.
So you borrowed $100,000 during that time, or you borrowed enough and it had grown to $100,000. So you sell your home, you pay off the $100,000 because that's what's owed the bank.
Mhm.
You take the equity from your home. Now you've got a big chunk of money.
Mhm.
You can use a HECM, ladies, to purchase your next home.
You lost me.
You can
We
so
both went, wait.
you can use a reverse mortgage to actually purchase a home, right?
Oh, okay.
Right,
Yeah,
to
yeah,
purchase a home.
yeah. Okay.
So this is what people don't realize this.
I
but
did not know that.
yeah, yes, yeah. This is the best kept secret in reverse mortgages. You can actually use a reverse to purchase them. So let me give you a quick example,
Yes,
okay?
please.
Yeah.
So again, I'm just using rough general numbers here, but you've got a 78-year-old borrower and they want to go buy. They're going to have to make a lateral move, right? They're still healthy. They're in good shape. They have to go from a 2-story to a single story to a ranch style home. You tried like mad to get them to go down because everybody wants to downsize, but you can't, right?
Mm-hmm.
So now they're making a lateral, right? Unfortunately, now they're making a lateral move.
Mm-hmm.
So they sold a $700,000 house. They're buying a new $700,000 house, but it fits their needs. Okay. Historically, they don't want to do that. They're looking, right? They want
Lower. They want some cash in the bank.
They want some cash in the bank.
Mhm.
So let's say they walked with $600,000 of equity. Okay. They can buy a $700,000 house with a HECM reverse mortgage and put down approximately 50%. Okay, so they can put $350,000 down on a $700,000 home, live there rent free. Okay, because so you $700,000 house
Wow.
minus a $350,000 down payment. The balance is a $350,000 loan with a HECM that has no monthly payment. So now they've just bought a comparable house. They only had to put $350,000 down, so they have $250,000 left over that they can invest. They can.
Or they could
Go buy
They could-
their
they
Florida
could
home.
pay more down or whatever they wanted to
They
do, right?
they could put
They
more
could.
money into the loan, yeah, but
they
right,
But
they
why
could.
would you?
But yeah, why not just put $350 down, live in a $700,000 home, have no monthly mortgage payment, and then go use that extra $250 to
And your qualifying process is easier. Same thing. Is it still the same
100%? Yes, correct,
qualifying process?
correct. It's going to be easier, especially as it pertains to debt to income ratio, right?
Yes.
Your ratio is as far as your income versus your debt. Yeah,
This is huge for people trying to downsize.
it's a really great tool.
I didn't know you could buy with one. That one, I mean, you've taught me a lot today, but that one really got me.
Right? And I mean, especially as it pertains to you guys, I mean, obviously, you're agents, you've been doing this a long time. I mean, this is a great tool. So
Okay.
I want to talk about, I'm going to give you one more purchase
Yes,
example. Okay. Okay, so check this out, ladies. In the reverse world, I like to call this right sizing, right? Because we want to downsize, but as we've already
I like
discussed,
right size.
right size.
I like to write that down.
Got
I
it.
like to right size
Okay.
instead of downsize.
Right? Instead of downsize, we want to right size because
Yeah.
sometimes you can't downsize. So
No.
I'm going to call it right sizing.
I like
So I had a couple that lived in Thornton. They owned a home in Thornton, nice home that they mostly owned. They almost owned it free and clear. It was worth about $600,000. They wanted to be next to their only granddaughter and their only daughter in the whole wide world that lived in Golden. You guys can appreciate this. But they
Yeah.
would drive 3 or 4 days a week. It's 30 minutes each way, right? I mean,
Yeah.
as Denver
Easy.
Metro people, we know. So they're like, we really want to be in Golden because this is where our granddaughter is, and as she gets older. So they were tired of driving. So they sold their home in Thornton. They're trying to buy a home in Golden. Well, guess what?
It's a little bit more.
Prices.
Thank you. You took, yep, exactly.
A little bit more.
So guess what? They found the home that they really loved. It was $800,000.
Uh-huh.
Okay. So basically what happened was they sold their home they netted about $600,000.
Mm-hmm.
They bought an $800,000 home in Golden. They put, just for real easy math, they put $400,000 down on it.
Mm-hmm.
They're now they're living in a nicer home, a more expensive home in Golden, right by their daughter. They have no monthly mortgage payment. They ended up having about $150,000 left over that they could just basically set aside, put in investments, so that so she slept better at night. They had money to draw from if they needed it out of a bank account or investment, and they're in really a more expensive home.
And they save money by the gas and the wear and tear on their car and their time and all that.
Exactly. I mean, it was like
That's a great example.
it was such
But
an
that's
awesome.
what you can do.
That's what you can right size with a HECM reverse mortgage, and it is a game changer. The financial flexibility that this loan creates is incredible, and if people knew it, millions of more people would jump on board with this loan.
Wow.
Okay, so we're gonna have to wrap it up just because
We could talk
He
about
has
2
to
more
leave.
hours.
So
Let's
what
do it again.
People do? Let's do it again.
Yeah.
But what do people do to start the process? Just call you?
Yeah, I mean, if they just want some general information, right? That's the best place to start because people need to understand. We need to dispel myths. I welcome, if mom calls me and she wants her 2 daughters to be there
Oh yeah.
because she does,
Yeah.
and I'm doing a loan like that right now too.
Yes.
I've got daughters in the East Coast and one in Denver. We're doing a Zoom call so the daughters can be part of it.
Cool.
I want to give them all the information. I want to answer the questions. We want to run different scenarios. We want to tell mom, hey, we can pay you monthly payment. We can put money in a line of credit, right? We want people to be comfortable with it.
Right.
And I want to make sure it's a good fit for them too, right?
Yes.
It's not a fit for everyone.
This is not a one time and done
No,
conversation
you're gonna
with
have
you.
to come back.
I mean, I can see you're having to meet with people multiple times for them to be comfortable to do this.
Yes.
Like with a loan, you sit down and you're like, well, let's go find a house.
Yes.
There's so much to this.
different ways you could do it.
Yes.
Yes, I've met with this woman in Littleton now twice in person and twice with her and her 2 daughters
I can see
on,
that.
on a Zoom call because her one daughter had a lot of reservations with it.
Heard the myth.
Heard the myth, heard the bad
Yeah.
press,
So hard to dispel
and
that.
and so it's like it's a longer term process because you got to give people the education. They got to understand how it works and what they're getting into, right?
But
Right.
you're passionate about it, and obviously you put your mom through it, and I think Kim's gonna call you soon. I saw her eyes rolling when you were talking about it. I feel like you're gonna get a new client
You need to
here.
talk to your dad. Good luck.
Oh, God.
That's fine.
I'll be there with you.
Okay, good. Yeah, let's go. I say the more the merrier.
Yeah.
All right.
Yeah.
But it's really true. I mean, my dad has a reverse mortgage in Iowa as well that I helped him with. So I'm a big proponent of this.
Well,
Well,
it makes sense.
I would think so.
Yeah.
And I think it's good. So we'll wrap it up with this. We'll probably have you again, Tim, because
love
I
it.
can't imagine the
Yeah.
questions
We're gonna
that we're
just
going to
think
be
of.
getting. And
We're in the industry, and these are questions that we thought of. I can see why it would be hard for other people to understand it.
Right.
You know?
Oh, absolutely.
There's
Yeah.
so many nuances and elements of this loan that it does take a lot to unpack it, right? And all
Yeah.
the things you can do with it. So I'd love to
We'll come
be
back
a guest
with
here
more
again.
questions.
Good.
Yes.
Thank you.
Well, thank you.
Thank
We'll
you.
put all of Tim's information below so you can contact him. Or if you want to contact us, we'll get you to Tim. But man,
And be sure to subscribe.
like and subscribe for more videos. And he'll be back, so like and subscribe for him.
Yes.
There you go. Thanks, ladies.
Thanks.